What's up traders, Dennis here with NeXtGenBulls, and in this video we are going to go over the basics of the options chain on the thinkorswim platform by TD-Ameritrade. If you're relatively new to trading or hedging with options, or even just paper trading options at the moment, opening up and reading all of the data in the options chain for the first time can be very daunting in the beginning for new traders. What we want to accomplish in this video is to show you the basics of what you need to know and look for when shopping around for options. Alright, so let's get started. So, starting from the monitor tab, we're going to click over here to the trade tab. If you do not have a stock up here in the search bar, go ahead and type in the ticker. We're going to use Apple because why not? If the options chain didn't appear right away, as it did here, just come down here to where it says options chain and give it a click. Now, the information we have in front of us here is the different option expiration cycles. If the stock you are looking at is actively traded, then chances are it's going to have listed weekly options, as is the case here with Apple. You'll see the weeklies are highlighted in yellow. Some traders do not like to trade weeklies, so if you prefer to not have them displayed on your chain, you can go up here to the filter setting. Here on expiration types, you can toggle it to only show the regular monthly options. Now, with our Apple example here, we have a lot of different expiration cycles to choose from. Which one you pick to trade is up to you, your selected option strategy, or trading system that you practice. But before we go on to select an expiration cycle, let's take a look at the information to the left of the option. The first piece of data listed is the expiration date of that option. The format will always be the day, followed by the month, then the year. So this option here expires on the 19th of March of 2021. Next, we see here a number in parentheses. This indicates how many days to expiration this option currently has. In this case, this option has 38 days before it expires on the 19th of March 2021. This number changes daily until the counter hits 0 and the option expires and ceases to exist forever. Finally, the value here is 100. Now, a vast majority of the time, this value will be 100. This 100 multiple signifies that this option controls or represents 100 shares of the underlying stock. We will brush up more on this a little later, but a vast majority of the time, option contracts will represent 100 shares of the stock. The only other time when this multiple is another number is when the stock has a split or a merger. In this case, the multiple will change. Now, with these fundamentals out of the way, let's open up a chain. We will use this 19 March 21 example to keep things consistent. With our selected option chain open, the first thing we will notice is a bunch of numbers in rows and columns. These rows have values here in the center. Next to the option expiration date are the strike prices. The amount of strikes are customizable. To add more strikes, go up here to where this drop-down box is located and hit the down arrow. There are some presets built in, but say you only wanted to see 50 strikes, but since that number of strikes is not listed here in this preset, we can type it in here and the options chain will adjust. I normally like to look at all the strikes available, so I'm going to select the all preset. So we have our expiration date and strike prices here in the center. Let us take a look at the columns now. To the left are all the listed call options, and to the right we have all the listed put options. On thinkorswim and most brokerage platforms that I've used, calls will always be on the left and puts on the right. You will also notice some strike prices are shaded in purple. Here in thinkorswim, strikes shaded in purple are in the money options. Everything else is black and is an out of the money option, and the strikes closest to the current stock price will be the at the money option. Under both calls and puts, you will also have the bid and the ask price. These columns here are not customizable or removable, as the bid and the ask are two of the most important pieces of data you will have in the options chain. For new traders that are not aware, the ask is the current market price that you can purchase the option. So, if we look at this 140 strike call option, the current ask price is $4. Now, this might sound very affordable or cheap, but these prices represent price per share of the stock. Now, remember that 100 multiple from earlier? Typically, option contracts represent 100 shares of stock. So this $4 call option will actually cost us $400 plus commissions. Vice versa here on the bid. The bid price is the current market price that you can sell the option. For this same 140 strike call option, we can sell it for $3.95. Same principle applies here. This represents the amount per share. So by selling this 140 strike call option, we would collect $395 in premium or credit. Now, a serious disclaimer here. This might sound amazing. We sell this 140 strike call, we collect $395 per contract. If you're new to trading options, don't go selling calls or puts everywhere just to collect money. Selling options can carry great risk if you don't understand how to properly use the strategy. When you sell just a call option, this strategy is known as a short call, or in option trader lingo, we call this a naked call. The naked call has theoretically unlimited risk to the upside. Need a reminder? Go look up at what happened to Melvin Capital during the GameStop short squeeze fiasco. With that disclaimer out of the way, let's look at one more detail regarding the bid and the ask. By taking the difference between the bid and the ask, you will get what's known as the spread, also known as the BidAsk Spread. Using our 140 strike call example, the spread here is 5 cents. In this example, this spread would be considered tight, which is great for liquidity reasons. The tighter the spread, the better. Different options traders will have their own preferences as to how wide is too wide of a spread for them. I personally do not like to see spreads wider than 10 cents. Spread widths can vary based on a variety of factors such as strike prices, how far in the money or out of the money the strikes are, how actively traded the stock and its options are on a daily basis, and even the price of the stock, just to name a few reasons. Also, in times of increased market volatility, it is not uncommon for spreads to get wider than they typically are, so be sure to keep an eye out on spreads when you're selecting your option strikes. The data that we can customize on the chain can be done on these columns here. If you're opening up the option chain for the first time, you will have a default preset already selected here. To customize, simply click on one of the columns and choose a piece of data from the drop-down menus here. What I normally recommend new option traders to set on their chains is delta, open interest, and volume. In my opinion, open interest and volume will play a critical role in your decision-making process as to which option or options to trade. Open interest measures how many contracts are currently outstanding. In other words, how many contracts are still open. When you buy an option, you are buying to open the contract. On the other side of the transaction, there is a seller who is selling to open the contract simultaneously. When it comes time for the buyer to close the contract, the buyer will have to sell to close. Vice versa, the seller will need to buy to close. Once both parties have closed out of the contract, the closing process is recorded here by the volume. The volume displays how many contracts were closed during the trading session. This value here for the volume resets to 0 every day, while the open interest remains unchanged until contracts are closed. So, why is this data even important, you might be asking yourself? Well, it all comes down to liquidity yet again. High levels of open interest means there is a lot of participation in that option. With increased levels of participation, the options will become more liquid and easily tradable as far as getting in and out of the trade at a good price. In this example, you will see these option strikes have thousands of contracts open with relatively narrow spreads throughout the different strikes. This kind of participation is what I look for when choosing option strikes on stocks that I have on my watch lists. Here is an option chain for Shake Shack. Notice here how the open interest is pretty low, as well as the volume for the day. The spreads on these strike prices are pretty wide as well. This is an example of a stock I personally would disqualify from an options trade. However, if Shake Shack had a very attractive chart setup, I would probably just trade the stock instead. Alright traders, this was a basic 101 video on option chains and thinkorswim. If you got any value out of this video, smash that like button to the moon and consider subscribing for more educational videos and other trade related content. This is Dennis with NeXtGenBulls signing out.